advise that everything that you're about to hear, if you don't have a recording apparatus, will be available on our website at www.askthewiz.info on demand for your perusal. That's www.askthewiz.info. Now, family members and listeners alike, if you're worried that your struggle to find profits from stocks for the next 5 years will be insurmountable, you shouldn't worry about that. There are still plenty of outside gains waiting to be had. And at this particular time, I want to discuss with you, and I'm going to show you exactly how to get P.A.I.D, how to get in on the action that the uber wealthy are getting in on consistently to get paid. Now, first, we need to talk about what's making stocks harder to invest in these days. And it boils down to 2 points. 1, valuations are far too high. And 2, interest rates, albeit slowly, they are indeed rising. Now, when stock valuations rise too far, they inevitably come back down to earth. The S&P 500 is now trading at a price to earnings ratio of almost 25, and that's the highest level in a generation except for 2 other times, in 2000 and 2007. That's right, just before the last 2 big stock market crashes. Now, this has a lot of professional traders and investors worried. And it's true, a lot of Americans would probably be better off staying out of the market because they can't find winners as easily as they did back in 2012 when the S&P 500 PE ratio was a measly 14. But that doesn't mean you, we, the Ask the Wiz Wealth Institute family and listeners alike should give up. No way. Because we can do far better than most people. In fact, we can easily grab 7% dividend yields right now and 13% annual total yields for the next 5 years or more. Let me explain why, and let me explain how. Please listen very closely. Now, you see, family members and listeners alike, the key to getting a strong return when stocks are overvalued is simple. You need to be selective, and you need to diversify into other investments. Now, if you choose stocks that can withstand a correction, you're going to protect your portfolio. And if you add other assets like bonds, your portfolio is going to grow even during a bear market. Now, when we take this one step further, slashing our risk to the bone by choosing a variety of funds that go up when the stock market goes down, that is, they perform inversely to the stock market, and we can add more insurance by investing in funds that give us a high rate of current income through dividends. Take, for instance, write this down, the PIMCO Dynamic Income Fund, symbol PDI. The PIMCO Dynamic Income Fund, symbol PDI. This position has a whopping 18.5% annual return since inception. Now, thanks to its 8.6% dividend yield, much of that return is safe from market volatility because it comes to you in cash. PIMCO Dynamic Income Fund, symbol PDI. Now, with the S&P 500's paltry 1.9% dividend yield, much of your returns are coming as capital gains, which only exist on paper and can disappear in a blink of an eye. PDI's cash advantage is why it has crushed the S&P 500 since its IPO in the year 2012. Now, this clearly demonstrates a crucial point most traders and investors, most people miss, and that is dividends aren't just about getting cash every month. They also cut the risk in your initial investment by helping you cash out some of your returns on a regular basis. This is why professional investors love preferred stocks. Listen to me closely. Preferred stocks like Goldman Sachs. Preferreds issued by Goldman Sachs that are like the ones that Warren Buffett bought during the financial crisis, and which went on to hand him a double-digit annual return over several years. You see, the real secret behind that return was the dividends. Goldman agreed to pay out a special 10% annual dividend payout just for Buffett's preferred shares, which means Warren Buffett was getting $500 million a year on his initial investment until Goldman repurchased those shares in March of 2011. Now, investors who try to replicate Warren Buffett's investment with common shares didn't do so well. You see, those Goldman Sachs common shares weren't getting Buffett's 10% dividends. So, of course, their returns weren't as good as his. Now, listen to me. I've done the homework so you can pass the test. Yours truly has found a position that will allow us to fortunately easily replicate Buffett's strategy with a particular closed-end fund that is named the John Hancock Premium Dividend Fund. That's the John Hancock Premium Dividend Fund, symbol PDT. Now, PDT has returned 13.9% annually over the last decade while paying a 6.9% dividend. That's John Hancock Premium Dividend Fund, symbol PDT. 13.9% annual return over the last decade while paying a 6.9% dividend. Now, PDT has had double the total return that stocks have had over the last decade and was even outperforming stocks during the dark days of 2009. And the uber wealthy flocked to PDT to continue to get P.A.I.D during the last recession. Now, listen to me closely and write this down. Okay, I'm going to give you 3 steps. I'm going to get to that in just a second. I need you to write these 3 steps down. Now, preferred stocks and bonds are just the start. To really protect yourself from stocks' high valuations and low expected returns, you need to build a portfolio of high dividend paying funds that are attractively priced now and ready to hand you, me, we, the ASK THE WIZ Wealth Street family and listeners alike, some of our gains in cash on a regular basis. Now, fortunately, there are hundreds of closed-end funds that aim to do exactly that. And many of them even pay dividends monthly. Plus, a lot of those funds have beaten the S&P 500 over the last few years, some for a decade or more. So here is what you, me, we, the ASK THE WIZ Wealth Street family and listeners alike, this is what we need to do. It's as easy as 1, 2, 3. Step number 1, write this down. You should invest a set amount of cash in a group of high-yielding closed-end funds, CEFs, when they're attractively priced. This immediately gives you a 7% plus income stream. Step number 2. Over time, your account's cash balance will grow to the point where you can add to the portfolio by choosing funds that are attractively valued at that time. And step number 3, as you build up your portfolio by buying more funds, you'll be more diversified and you'll be getting a growth income stream thanks to the power of compounding. Now, family members and listeners alike, by following the simple steps of actualizing and buying, collecting dividends, and then actualize and buying again, you'll easily set yourself up for double-digit annual returns year in and year out, including your growing cash payouts, while shielding yourself from the upcoming market crashes. Family members, when you listen to this again, and if you've taken copious notes, you will see that I've just laid out 2 wonderful positions to get you paid like the uber wealthy. Then I gave you step by step what you need to do on alternative positions, i.e. CEFs, closed-end funds, that will get you P.A.I.D as well. Providing you with information that will allow you to not only obtain, but also maintain your economic liberation. That's what we do here in the Ask the Wiz Wealth Institute.